So welcome. This is going to be a session on how to know where to put your money to make money. And I wouldn't say have it necessarily safe. Nothing is 100% safe, but to invest defensively in these tricky times. Now, to help us with this Q&A webinar, it is a Q&A. Do ask any questions that you like of our experts. This is a time that you can, safe space, no question is too dumb. You can either put up your hand and actually ask it or put it in chat, no problem. Izzy, the lovely Izzy from MoneyMagpie is going to be keeping her eye on the chat and telling me, and I'll keep an eye as well. So we'll ask the questions. Oh, and I have to say this every time, by the way, nothing in this webinar should be construed as financial advice. Just take it as information and then you do your own research or speak to a qualified financial advisor. This is for information only. Now, to introduce you to the team, first of all, I have Sam North and Ben Laidler, who are investment experts at eToro, and eToro.com is sponsoring this event, which is why it's free. So we thank you very much, guys, for that. Say hello, Sam and Ben.
Hi, guys. Thank you for having us on, Jasmine.
Thank you. Ben.
Yeah, likewise. Thank you very much. Great to be here.
Lovely to see you. We have George Sweeney, who is MoneyMagpie's investment editor. And George, where are you sitting at the moment? Whereabouts are you calling from?
I'm sitting in sunny Costa Rica right now. Just woken up.
It's a tough life, but somehow we're international at MoneyMagpie. I'm hoping to get Justin Urquhart-Stewart, but I also have Gordon Kerr from Cobden Partners. Gordon, say hello. Unmute yourself.
Hello.
Great, thank you. Now, as you know already, this webinar is going to look at where new investors and experienced investors can put their money in these uncertain times. I keep being asked, for example, where can people put their savings? And mostly they're talking about savings accounts. And they're saying it in bags now because inflation, as we know, is, well, headline rate is 7%. Personally, I think it's actually into double figures in real terms. But anyway, they're saying 7%. Your average savings account gives you 0.05, very little. So the big question is, where can we put our money? And I'm going to put this to you guys first, actually, this question. If someone wants to find an alternative to savings accounts where they're losing money, where should they look? What would you say are the safer, in other words, less volatile investments? I'll start with you, Ben Laidler. What do you think?
I would say a couple of things. So, one, this is we're in a sort of new investment world. So maybe everything you've seen over the last few years, I don't really think applies anymore, right? There's you made the point about inflation, right? We've got more inflation now than we've had in a generation. Growth rates are coming down, inflation rates are going up. This is very, very different from the world we've lived in, certainly over the last few years, and you can push it back, even decades if you really want to. So your question is very well taken. Diversification is absolutely the name of the game. You don't want to have all your eggs in one basket. That would be point one, and I think point two is to take the long view. If we're being brutally honest with each other, whether the market's going to go up tomorrow, next week, even next month, is basically a coin toss, right? That's what the statistics tell you when you look back. But if you're telling me you're investing for the long haul, I can come pretty close to guaranteeing you a positive return, right? So I think diversification and taking that long view are very important. And the other point I would just say is, now's an interesting time. I mean, we were all worried about, things were too expensive. I've missed the rally, et cetera, et cetera. Well, hey, guess what? Markets have now come off a little bit, and worldwide a whole different bunch of things. But I guess to answer your question, so what do we like today? The two risks in markets are that valuations keep coming down and that growth keeps slowing. So how do you defend yourself against that at the same time as trying to make some money? You own things that are very cheap. So the valuations, you're running a lot less valuation risk. That keeps you out of things like tech, which has done very well the last few years and is very expensive. And it pushes you into things that we all forgot existed over the last few years, like commodities, like financials, like some of these defensive sectors like consumer staples and utilities. And I think that's the other sort of thing you need to look at. You know, what are the advantages of things like utilities and food and beverage companies and healthcare companies? Is that we're still going to be using them, whether we're in recession or whether economies are booming. So this sort of stability of cash flows, I think, is a real anchor to people's portfolios, and the valuations are pretty good because we've all been chasing tech stocks for the last 5 years.
Yeah, so you're still talking stocks and shares, basically. So you're saying that because I mean, I have been saying this for a long time with people talking about their savings. They're often really talking about long-term investments, and I'm saying, well, you shouldn't have, you know, quite so much money in cash anyway. But you're saying, so even there, for their savings accounts, they should really be moving a lot of them into stocks and shares.
If they're taking the long view. I mean, again, you look at the long-term numbers, you're going to get the best return over the long term out of shares than you are in most other asset classes. Now, we're talking about the here and now. Then obviously commodities, I think, is interesting, and there are some of the other asset classes. You know, crypto, obviously, with a much higher level of risk attached to it. You know, there are other asset classes sort of out there which I have a place in people's portfolios. But I think the core of people's portfolios, if they're looking to build wealth over the long term in a diversified fashion, equity should probably be the biggest portion of that portfolio.
Now, I'm just seeing in the chat, Andrew, Burham and Alan are talking about gold and silver. And Gordon, I know that's in your area. You're very much a fan of gold and silver. What would you say to the answer, you know, about savings? Should we be moving our savings mostly, do you think, into gold and silver?
Thank you, Jasmine. Yeah, I mean, I agree with much of what I've heard, with the possible exception of the slight enthusiasm for crypto, which I regard as kind of financial junk. But one thing I would say is I tend to focus more at the 30,000 feet level than on an individual stock and share picking and so forth. I tend to put my personal money into funds, and in fact, I'm here in St James's at a conference of a hedge fund that I'm associated with right now, which has been discussing all day just the same sort of issues. They've been focused on, I mean, obviously they're investment pickers and massive amount of research required to choose individual stocks. I wouldn't necessarily think it makes a great deal of sense to just go for a FTSE tracker, because you look at the price earnings multiples now, same in the States, compared to, I mean, I don't even know what the price earnings multiple is, and on the FTSE is probably something like 30 times, compared with Eastern European stocks at 3 or 4 times. You know, there does appear to be quite a lot of price differential, especially with potentially leveling events such as wars on the horizon. But at the 30,000 feet level, the main thing I would urge your viewers to consider is the constant debasement of cash, particularly since the 2007-8 banking crisis, which I think a number of people seem to have fallen for the spin that it's kind of been fixed by central banking policies. I don't think it has been. I think that if the central banks had been skilled with the techniques of quantitative easing and money printing in 2006, as skilled then as they are now, I don't think there would have been a visible banking crash. You'd have ended up then with just 1 or 2 more like Bear Stearns and Lehman Brothers in zombification state, still employing people, still draining resources. And this is precisely why we're seeing inflation, as you rightly say, Jasmine, way more than 7% in the UK in particular. I mean, I've been around since the dawn of retail price indexed derivatives, and we were debating heavily with the Bank of England at the time the composition, and clearly everything was going into the constructing a basket of items whose values were perceived to have little chance of rising, which is why all housing costs were excluded, because housing has always been galloping away ever since the negative equity crisis of the early mid-90s, when our chancellor put interest rates up to 16, 70%, something like that. Of course, those were the last days, really led by Volcker in the US, when there was any serious attempts at rectifying the kind of imbalances that drop out of unrestrained fractional reserve banking. And so I'd be cautious about anybody investing in bank stocks now. You see the rise of fintech and companies like Monzo, which are valued at extraordinarily high levels, but of course have never made a profit, and their only business plan to make a profit is to get into lending. Well, hey ho, isn't that how banks have problems in the first place? Because there are too many banks chasing too little stuff. So yeah, of course, I certainly agree with the idea of picking good long-term investments. The idea of making money in the short term is neither here nor there. I also have quite close relationships with one legendary investor, Nigel Ray. Some of you may have heard of him. He was behind the Bertha Group, Trocadero. I mean, the new class of private equity stars from the 90s, like Hugh Osmond, were inspired by Nigel Ray. He's famous more for his ownership of Saracens Rugby Club, the Manchester United of rugby. But he told me in one of our private meetings that, you know, he stopped dealing with investment banks like Goldman Sachs because they always rang him up and said, why don't you buy Jones and Co. and sell Smith and Co? And he says, why would I sell Smith and Co? I don't want to sell anything. So I think the message is invest for the long term and be very careful about what risks that you take and understand them. But I've said enough, I think.
Like Warren Buffett, yes. So Sam, we've got a very good conversation going in the chat about gold and silver. We've got mentioning an ETC. And what do you think about, you know, if somebody wants to move some of their money from savings into something relatively stable, which used to be bonds? You know, we used to say, oh, put it in bonds. Bonds are hopeless now, it seems to me. Do you think that some sort of gold product, maybe an ETC or actual physical gold, would be a good place for some of it?
Well, yeah, I think, like Ben mentioned at the beginning, and Gordon said there, it's good to be diversified, right? And the useful thing about being, or the good thing I should say about being a retail investor, is that you don't necessarily have to have a timeline. You don't have to say, oh, I need to make these returns in 3 weeks or a month. It might be that you are looking to, you know, average into these products on a monthly basis or a quarterly basis. And it might be that it is something that you look for, you know, for in retirement, and that could be 10, 20, 30 years. And yeah, I would recommend being diversified. I would have, well, personally, I do have some gold ETFs that I would invest in on like a, you know, quarterly basis. In terms of someone just trying to time any market at one individual point, it's going to be tricky. I mean, if we had this webinar a couple of weeks ago, you know, NASDAQ would be on the high of the month and everyone's happy. We have it 3 weeks later today, and suddenly the NASDAQ's down 3% today. It's down, you know, over 10% from its high. So timing is tricky. I think gold yesterday was down 1% at one point. So, you know, would I invest and have some of my money in gold and silver in ETF trackers for those? Yeah, I would. But it would be more like I would split those investments into something where I would invest every month or every quarter to sort of try and navigate through that volatility, which we're going to see as well. Yeah. Gold isn't guaranteed to go up over the next few months because of, you know, people consider it a safe haven. It might be that because interest rates are going to go higher and higher than people might think, that, you know, the dollar's going to strengthen, then gold's going to come under pressure and gold moves lower. So it's going to be tricky. Like Ben said, for a lot of markets, it's a coin toss right now. But yeah, the approach of being diversified, having, you know, part of your portfolio allocated to gold or silver, whatever it might be. Yeah, I'm all for that.
Excellent. And if I just go back to Ben for a moment, you know, we're talking really diversification. As I mentioned, it used to be that you'd say 67%, 70% in shares and other sort of quite volatile products, 30, 40% in bonds. But surely you do, I mean, I personally wouldn't touch bonds right now. It seems to me like complete waste of time. What do you feel about, are there any bonds that are worth putting in? And if not, how do you diversify your portfolio? What would you say are the best sort of percentages?
So I'd say a couple of things. I wouldn't discount bonds entirely, right? They've obviously had a tough time, and what bonds have lived through in the last 3 months has basically been the worst 3 months that bonds has ever had. So just to put this in perspective, and the result of that is that bond yields have gone up. So prices have gone down, bond yields have gone up. And I mean, depends which part of the world you're looking at, but bond yields are now on the cusp of giving you a real return. So bond yields minus inflation. Now, you know, that's not very much, and that doesn't mean there's not a bit more pain to come, but I wouldn't throw them out of the portfolio, A, because you're now getting a better yield on bonds than you have done for years and years, one, and two, you know, we're talking about diversification here, and we want to manage volatility in the portfolio. We want to manage the level of risk in the portfolio, and bonds is a lower risk instrument, has a lower return, but it also has a lower risk. And if we're going to own lots of equities or, God forbid, crypto, or these other sort of higher volatile or riskier asset classes, you need something to offset that. And you know, that can be cash, but I wouldn't, you know, discount bonds. I wouldn't discount bonds entirely. And I just want to say one other thing, actually, just to pick up on what Sam said, especially because, you know, markets are volatile right now, and that can be, you know, that can be frankly terrifying for people. And I think it's worth just bearing in mind, you know, how you manage that. And I think, you know, Sam talked about just dribbling money in over time, and you say, you know, what do you do if you have savings? You know, don't put them all in today. You know, dribble them in, you know, a little bit a month over the next sort of 12 months, because, you know, that will do two things for you. That will help manage this volatility. You know, chances are you won't invest everything at the bottom and you won't invest everything at the top, but you're going to get a good sort of price, one. And two, you're going to be there when markets do go up. And the one thing I can say with complete certainty is they are going to go up at some point. And so, you know, I often say, especially if you're investing for the long term, the biggest risk is not being in markets. It's not being invested in markets, it's not being in markets. And the problem with volatility like this is it keeps people out, you know, and market timing is a little bit of a fool's game. Even the best investors in the world, you know, don't do it consistently well year after year after year. So I know Gordon's about to sort of jump in and crush me on the Zoom. So,
okay, yeah.
Far from it, Benjamin. I'm sorry if we disagree on Chris, but other than that, I agree with the vast bulk of what you say. Also, Jasmine, as you know, as a dedicated fan of much of your other published work on TV and MoneyMagpie, I'm well aware of your concerns about the risks of central bank digital currencies and maybe leading to a Bitcoin abolition of cash. You know, if you inherit, you know, £1 million today, let's talk serious money, you've got a choice of buying some kind of 30-year index-linked government bond yielding something positive. That might look very attractive if the Bank of England set rates to -8% in 5 years' time, having abolished sterling. So it's very difficult to be too generalistic about this sort of thing. And clearly with bonds, the other issue here, of course, is that, you know, in the US, you're seeing Treasury bond yields going north of 2%, I think, so forth. Europe is very different. The ECB is making every noise in their last Thursday announcement that they are taking such a long-term view of their inflation target that they're going to do nothing. If in the next 50 years they can see some kind of inflation rate of 1.8%, then that justifies doing nothing. Now, I think in Europe in particular, with an unfederalized euro currency, which I think is really under immense pressure of cracking right now, the likelihood of rates going up at all is zero. I mean, I've put this in writing before. I don't think the European Central Bank can raise rates, and therefore you'll see situations whereby the markets expect the yield curves to rise up and go long term, but then the ECB is just going to set rates lower and lower and lower. Now we have this, forgive me using a technical term, you have this negative real interest rate expectation in Euroland of -8%. Well, what that means is that the ordinary saver, you know, with £100,000 is going to end up with £92,000 worth of value in a year's time. That makes holding cash extremely unattractive for any substantial savers, and also is evidence of financial repression, which is very similar to the way the Soviet era monobank operated for 75 years in Russia, 45 years in the Eastern European Comecon states, with, you know, the natural result of the hyperinflationary collapse in 1980-1991.
So you're saying that the way they're running the finances in Europe right now is very similar to the way that the Soviets were running theirs?
Absolutely. There's a book by Janos Kornoy, published 1980, which was analysed in a brilliant paper by a French economist, Eric Magnan, and a Bulgarian chap, Nicholas Stanovsky, who's the present governor of the Bulgarian Central Bank. Last year, I can send a link to you to distribute to the participants if they wish afterwards, where it draws enormous parallels with Kornoy's work, The Economics of Shortage. How, you know, the Soviet era monobank was determined to present its model as superior to capitalism. The way they did that was they set fixed and constantly depreciating prices of goods. The technique for doing that was creating shortages, so allowing only 5,000 loaves of bread to be sold in a town for 10,000 people, creating huge queues. But you could say that our central banks, including, dare I say, the Bank of England, are doing much the same thing with their techniques of financial repression, deeply negative real interest rates, huge money printing, which is the cornerstone of Soviet era monobank policy, and creating financial repression in housing for young generation people. It's becoming very difficult for young people to ever imagine house prices failing to rise by 10% per annum at the moment.
Ben, I'm going to go back to you. I'm sorry, George, I will come to you in a moment. But Ben, I'm wondering what you're thinking about that as well.
So I'm not saying run out and invest money in bonds. I'm just saying, markets change and bonds used to be, deeply unattractive, but given the performance and given where yields are going, they're becoming somewhat less unattractive. But I do think, I take the broader point, right? Inflation's running at 7-8% in the vast majority of the world at this point. One of the biggest questions investors need to ask themselves is, how do I defend myself against that? Now, I think inflation is probably going to come down a bit, but it's still going to remain, I think, uncomfortably high for most people for an extended period of time. So how do you generate that real return, that investment return above inflation? Now, equities have historically been, a pretty good place, especially, as I said earlier, those sort of cheaper equities that have pricing power, that have, good cash flows. But commodities, if you go back to the 1970s, which is the last time we had any real inflation, the best performing asset was commodities.
Yeah.
Now, gold was part of that, but it was the broader commodity complex as well. And therefore, I think it's no surprise that global commodities are up 30% this year. And it's basically, you've lost money in every other single asset class apart from commodities. And so I still think commodities is interesting. Real estate, is historically another of those sort of hard assets, which gives you a positive return in excess of inflation. And there are others, but these are the types of assets I think you need to be sort of looking at that can give you that sort of positive return over inflation for an extended period of time.
Now, I'll bring George in here because I have inside knowledge of what's happening at MoneyMagpie, amazingly. And I do happen to know that George is working on an article about, dare I say, cryptocurrencies and having a mixed portfolio of crypto. George, can you tell us, what do you, now we've all said crypto is very, very volatile. Everything's volatile at the moment, crypto in particular. But what have you found in your studies? What would you suggest to people, to investors, about possibly having their toes dipped into the cryptocurrency waters?
Yeah, so I guess I'm showing my age a little bit by being kind of interested in cryptocurrency, but I think it's just another kind of tool for diversification. I mean, a lot of people that have been holding on to crypto maybe in the last year have probably seen like a big boom. And I think there's probably a lot of like portfolios for younger people that are like way out of whack now, where it's gone from like a 10% crypto holding to like a 50%, like compared to everything else. So I do think that it's important to use it as a tool, as part of the portfolio, and not be throwing like everything into like the cryptocurrency. And yeah, what I'm working on at the moment is the idea of having a mini crypto portfolio within that. So not having everything in Bitcoin or Ethereum. You'd say have 5% of your overall portfolio in cryptocurrency and divide it in a few different ways. And it is that purely for diversification. And I mean, personally, like talking about like traditional kind of stocks to bonds, I recommended to my mum, who's like older than me, she wanted to invest. And so I recommended to her the traditional portfolio. I said 60% stocks, 40% bonds. And she liked the idea of that because it's what she's heard about. She likes the idea of less volatility. But to be perfectly honest, if I would have just told her to invest how I'm investing, she'd be in a much better position than what I recommended her to do because of her age and because she wanted more stability. And it kind of goes back to that thing of, everyone is different. But I also do believe in kind of, if you to explain to people how you invest and then see if they like that idea, because I kind of recommended a strategy to my mum that I don't actually use, which hasn't done her too well.
Well, actually, I've got a comment here from Andrew who says I also have some ISO 2022 crypto. So you've got XRP, XLM, ALGO, I don't know that one. YCD, I don't know that one. No, XCD, I don't know that one. But yeah, interesting. I've got some XRP actually, and XLM, yes. So these are the altcoins. So you've got the big one, obviously, is Bitcoin. Second biggest is Ethereum, and then there's some altcoins, and they're all sort of jostling for position at the moment, which is interesting. And actually, you've mentioned stability. Because the other thing in this country that we consider to be a stable investment is property. And there is a sense that property never goes down. I think it's going to at some point. But Gordon, if I can go back to you, because you have mentioned property going up. And so, I mean, obviously we have the pressure of people, just the population increase in this country. Small island, we're living on our own a lot more. Apparently 50% of the households are single. But you're saying also it's the money printing, the quantitative easing that has increased prices. Does this mean that it'll continue? Will price increases continue? Is property a good investment if you've got the money?
Yeah, I actually first had dinner with Liam Halligan about 10 years ago, and although I first became aware of your good self, Jasmine, on the Money Show on GB News, of course we didn't meet through that. We met through our mutual friend John Butler. But I know that Liam has specialised in house prices and written a book, and like the IEA and these other capitalist think tanks, they go on about supply and demand. Of course, supply and demand has an impact if there are forces at play which ensure that the government heavily subsidises housing for such a vast section of the population through housing associations and provisions for all kinds of deserving cases. There has to be some impact on house prices, but I don't think that is material. I think the reason why house prices are rising at such exponential levels, I read yesterday, I think it was 2%, house prices went up 2% in the last month. I mean, great. So any normal person like me who's got an ordinary house that they paid £100,000 for, which is now worth £1 million, I just made £20,000 in the last month. Fine. Why do I have to work? And I'm serious. You know, I think I have to work, but now I'm not so sure. I'll just borrow money against use my house as an ATM. But that's exactly what happened in the US throughout the years 2005 to 2007, 2008. It doesn't seem to me that this central bank money printing press is a very good idea for the wider economy. And I think it's the overwhelmingly most powerful driving force as to why house prices are increasing. So yeah, therefore, go ahead, use your money, buy houses, buy a diversified portfolio of buy-to-lets. But do you really think this will go on forever? And, you know, will you see the signs and get out in time? Clearly there will be changes. House prices at some point in real terms will fall. House prices have to be linked to income. In the capital of Outer Mongolia, Ulaanbaatar, you'll find that, you know, a mud hut trades for 3 shekels and a yak. And that kind of relationship, three times annual income of an individual, or 2.5 times a couple's income, that was the basis of mortgage lending throughout the 70s, 80s, when there was a period when mortgage lending was rationed in the 70s. You had to apply for a loan. Banks were only allowed to give so much money. Younger generation won't know this, but certainly 3 to 4 times income made some sense. Now that people are applying for loans on the basis of 20 times income, purely on the basis of the market price, the issue that we should focus on is the manipulation of the market price through financial repression, ultra low interest rates, and money printing.
Absolutely. So Andrew says he thinks property could crash by 50 to 80%. Yeah, it could. Hey, maybe it will. I mean, there has to be a point where people simply don't have the extra cash because prices of everything's going up. Sorry. The key point here is there is nothing in the nature of housing which implies as an investment it should rise in value. For 300 years, between the years 1614-ish and the outbreak of World War I in 1914, the price of a standard mansion in Eaton Square, Belgravia, stayed exactly the same. Zero inflation for 300 years because we had a sound money system. Then we have 2 world wars, massive money printing, and here we are today. Well, now Grant says, and this is an interesting point, the government won't let property crash. I mean,
he's right. That's exactly why they're printing money. But you know, that's the same approach of von Hevenstein in 1923 in Germany. The same approach of the Argentinians in the 80s and 90s. The most natural resource rich country on the planet, you know, has a currency that became worthless in 2002. You know.
Sorry, Ben, what's your feeling about property as an investment in this country? I mean, again, as you were saying, we're talking long-term investment. What do you think? Is it worth assuming a crash but keeping going for the long term?
So, you know, the more recent history of house prices, you know, since the war is that they tend to hold their value. the drawdowns, when they come, tend to be fairly short-lived, even if you go back to sort of, more recently to 2008 crisis. But what I would say was, everything in moderation, right? We're talking about diversification here. Let's not put all our eggs in one basket. And the problem with property, and I'll get on to the advantages in a minute, but the problem with property is it's generally one very big check to write. So you're undiversified. It's illiquid. It's difficult to sell when you need it. Yeah. It costs you a lot to buy it. The transaction costs are very high. You can go out and buy an equity on the stock exchange today for almost no transaction costs, or zero transaction costs actually, if you want to do it through eToro. Yes. But we all know what your transaction costs and your moving costs are going to be if you buy a house. And then you've got to maintain it, right? So the cost to carry is pretty high. So there's a lot of these sort of other costs which you maybe don't have with sort of traditional asset classes. Now, the advantage of it is, and I disagree with Gordon a little bit here, right? It's a hard asset in the sense that we know the chronic housing shortage we have in the UK, and there's no sign of that ending. So unless you think that we're going to find more land, or government housing policy is going to dramatically change and we're going to build on everything, then you're still looking at an asset class which is relatively undersupplied. And that's what I mean. That's why I put property in the same bucket as things like commodities. These are sort of hard assets, which frankly there aren't enough of them, and that basically means they're going to be reasonably defensive to things like rising inflation.
Well, yeah, and now Andrew's also made the point here that he has mentioned the possibility of interest rates going up to a realistic level. Not sure, to be honest, what a realistic level is. I mean, as Gordon pointed out, back in the 70s, it was into double figures. I mean, didn't it peak? I think about 20-21%. Finally, at the beginning of the 80s, to bring
inflation peaked at about 23-25% in the 73-74 oil crash. Interest rates peaked at about 16-17% right. in 1989-1990.
Okay, so 16-17. So, as you say, and I'm not sure what realistic means at the moment for interest rates. Personally, I would have expected interest rates in a normal situation to be in double figures right now. Frankly, I think they already, but it's at a tiny level. So the question is, I think, will interest rates go up? And I'm going to bring Sam in here. I don't know what you're feeling about it, Sam. What are we going to see interest rates go up in order to bring inflation down? Or do you think our government and maybe other governments are just going to go, no, that's going to cause a recession, or it's going to worsen a recession? We'll keep them low and make sure just cope with higher inflation.
Yeah, well, one thing I'm glad I'm not a central banker is the first thing I would say, because they've got a tough job. And also it depends where you are in the world. China are the only central bank that are lowering interest rates right now at the moment, which is incredible when you think about what's going on in the world with the high inflation. But yeah, they're lowering rates. Do I think here we're going to see higher rates? Yes. Do I think in the US? Yes. I think the next meeting, which is in 8 days' time, they're scheduled to raise rates at 0.5%. I saw a bank today come out and say they see rates in the US getting to 6%. I don't necessarily see that, but I think one thing right now is trying to predict how high rates go at the moment is going to be tricky, and it's going to be ever changing. You had people back in 2020, 2021 say inflation was going to be transitory, and it hasn't been, and it's been high for a long time. Some people think it will go higher. Some people think we've hit the peak. So look, I think rates are going to go up, definitely in the US, in the UK, in Europe. Who knows? Because it's going to be a tricky one. Maybe pigs will fly before rates go up in Europe. But I do think so. It's just to what extent. And the market, I think, maybe is getting a little bit ahead of itself in pricing in, really aggressive rate hikes. But we'll see. I think in a couple of months' time, maybe we'll know in a bit more detail, has inflation peaked? Are we starting to see that come down a bit? And then we'll have a better outlook on that horizon. I don't know what you think, Ben, about that.
What do you feel about rate rises, Ben?
They're coming absolutely everywhere in the world. It's just a question of how much, to Sam's point. right? I mean, we highlight China because it's the only central bank in the world which is not raising interest rates, and we'd be shocked if they weren't, right? With inflation 7-8% in most sort of developed parts of the world. To maybe take the other side though, to maybe give a little ray of hope in all of this, I don't think we're too far away from sort of peak inflation. I think the US is probably closer than the sort of UK. I think we have a few more bad months to come, certainly in the UK. But I'm a little bit more focused on, where the top is. I don't think we're just going to keep accelerating, to the moon here. And oil prices, I think, have had their move. Economies, including the UK, are going to keep slowing here. I don't think we're going into a recession, but I think this combination of sort of slowing economies, some bits of the market, car prices, I think we've seen the peak. So I would sort of take the other side of this view that inflation is just going to keep rising out of control here. It may stay. I think we're in a regime of inflation is probably going to come down a bit and remain on maybe uncomfortably high than we've been used to. Basically we've got used to basically no inflation over the last decade or two. And I think we're going to end up settling sort of somewhere between that and where we are right now. But I don't think inflation is going to keep sort of rising to the moon here. So central banks, including the Bank of England, are going to have to respond to that quite forcefully. But
it'd be interesting to see, because Gordon, I know you have to go soon, so I'd be interested to know what you think, because what I'm also hearing, to say, opposite to Ben, is that what we have at the moment is not true inflation. We've got price rises because of supply chain issues, but the true inflation from quantitative easing, that's still to come. What's your view, Gordon?
I think Sam made a great point. His contribution before last one, he says he would struggle to be, or he has a lot of sympathy with the plight of central bankers faced with the pressure to raise interest rates. What do? If they raise interest rates, then clearly that's going to have a negative effect on house prices, and it's also going to massively increase the cash bill for servicing the public debt. There was a headline in the papers only yesterday in the Evening Standard about the record 157 billion in the last 12 months just on debt service costs for the UK Treasury. So, for those reasons, I don't think that they can raise interest rates here in the UK any easier than the ECB, and I certainly don't think the ECB will ever raise interest rates. I'm happy to go now for that. Having said that, my predictive skills, I have to disclose, have not always been impeccable. In 1986, I was forced to carry a brick mobile phone around by Bank of America, and I famously wrote an email to everybody saying these mobile phones will never become popular.
Right, well, that's good to know. Speaking of the 80s, Grant said that during the 1980s, there was a property boom. Yes, absolutely. While interest rates were in double digits. I was a kid at the time and was getting, 12.75% on my NS&I.
Yeah.
Instant access savings account. I mean,
why would you want to access it?
Yeah, well, quite, because I think a lot of people, particularly retired people who live off their investments, they would be very happy with higher interest rates, and there are actually more savers than borrowers in the country. So, if interest rates did go up to, even 7%, we'd have a lot. I mean, I wouldn't have people asking me where can I put my savings. They just shove them straight into there, I think.
Yeah.
Which would be, sorry, carry on.
Could I just say thank you and goodbye, and pleasure to meet you, all of you, especially Sam and Ben, and thank you for your support. I'm sure eToro's a great platform and I'll take a closer look at it, but I ought to go now. So thank you very much.
Nice to meet you, Gordon.
Thank you for being here, Gordon. That's that's Gordon Kerr from Cobden Partners, who, as he says, he tends to take a 30,000 feet view of economy. And actually come back to George Sweeney, the MoneyMagpie investment editor. George, what are you hearing from other investors, or millennial investors, particularly millennial and Gen Z investors? You were mentioning that a lot of them have probably more crypto holdings than they jolly well should, but are they focused on property? Are they wondering about pensions, etc.? Where do you think they're putting their money or wanting to?
It's a bit of a strange one, because I think for a lot of people my age that have like a house or have property, they kind of make the mistake of not including that in their overall kind of port.
Oh, I think you've.
So people would like think of it necessarily as.
We're losing you, George. Oh, well, in that case, I will move to Sam. While
Can you hear me?
I'm just about. You're coming in and out, George. Are you all right there? Well, I will ask Sam for because while you get your Wi-Fi sorted, George. Sam, I know with eToro you have a lot of younger investors. You do very well on this. Where are you finding that they're putting their money? Is it the tech stocks and crypto on the whole?
Well, I mean, Ben can talk about this survey in a little bit more detail after, but we did a retail investor beat survey, or we do one every quarter, and we actually found that crypto was the second most held asset class of all, which was quite interesting to see that. I think it was more popular than, well, obviously it was the second most popular one, but more popular than say cash and commodities and so on. So we're seeing a rise there. For sure. The stats were quite interesting as well, as a very high percentage of people were happy with their portfolios as well. I can't remember the exact number off the top of my head, but from my point of view, I'm seeing and speaking to more and more people who want crypto in their portfolio. I did a podcast with someone called Anthony Pompliano, who's like big on the sort of the crypto Twitter world, and he's like 100% into crypto in his portfolio. Our CEO is more 50% crypto, 50% stock, so everyone's gonna have a different balance. For me, I've got around sort of 15-20% of my portfolio, so I still want to be diversified. As we've all sort of said, it's very high risk, but with high risk can come that high reward. And with eToro, there's crypto portfolios where you can diversify yourself, right? So we've got these specific portfolios that people might want to invest in, rather than just investing in just your Bitcoin or just your Ethereum. You can spread that risk. But yeah, we from the sort of the results we've seen, second most held. I think that is right, isn't it, Ben? Second most.
Yeah, absolutely. Which is, when you think about it, right, this is an asset class that didn't exist 10 years ago, and more people own it than own basically everything else other than domestic equities. It's dramatic.
It is. And the other thing that you do with eToro, which I do, because as you know, I have an account with eToro, is copy trading, and which I love. I actually copy Jay Nemesis, who I'm told is so popular now you can't actually invest in him. But the most popular ones, I mean, he has quite a diverse portfolio. I mean, a lot of tech stocks, a lot of crypto, but also Tesco, Lloyd's, all sorts. What the most popular traders that are copied, what are they investing in on the whole, the ones that are doing the best?
I mean, from what I see, it is mixed. And I think from what a user can do, which is why I think copy trader is great, is they can see everything of these investors. They can see what they're invested in, the percentage of their portfolio that they're invested in, like one account, one stock or one crypto. So it might be you have in a certain period of the market where you think overall markets are going to go up. I might want to go for someone who is a little bit riskier, who's got more tech stocks, who's got more crypto, and you can see that straight away. You can see their history, how long they stay in investments, how long they stay in trades as well. So yeah, it's a lot of the people that do, or have got the most sort of copiers, if you like, you will probably be the people that have performed the best over the last few years as well, because you can I was going to say judge, but you can see, or you can sort through the popular investors by performance. So if I was to do it, I would look, well, who's performed well the last few years consistently, rather than just who's had one or two good months. I want to see someone who's performed well over a long period. When markets don't do that well, how do they perform? Because let's be honest, I mean, look, the last sort of few months have been tricky, but there will have been some of these investors on eToro that actually performed okay, because maybe they have been more defensive, they've moved things around, and that might be of interest. But again, if you're long term and you're looking to hold your investments for a long period, do you care about 1 or 2 months? Probably not. And it might be, okay, well, let me have a look, see how they performed over a few years.
We've just I had a good note from Grant. He says we haven't lost George, we just suspended trading in him. Yes, we did. Well, we're going to start trading in you again, George. George, one thing that we haven't covered, we're thinking about new investors as well as current investors, is index tracking funds. Now, you've just written an article explaining index tracking funds. Are they still a good starter for investors? Because it's something that I've been talking about for years. I've got index trackers, I like them. Do you think they're still worth going for, particularly for new investors?
So short answer, I hope you hear me now. But yeah, going back to kind of what I was trying to say was that, like, for a lot of people my age, I feel there's a bit of a weird gap between you have really high risk investments like crypto, and then you have your house or your property. And kind of not much in between. So a lot of time, if I'm speaking to people that are kind of my age that want to kind of just get started with investing for like a really long period, like the easiest thing to say is like global, like ETF tracker. Start there while you're thinking about what you want to do elsewhere. Because some people kind of say dive in way too far at the deep end with like risky stocks or like loads of crypto. And what I kind of say to people is like, it's good to get started as soon as possible. And for the long term, that's a great place to just get started. And then like, as you learn, if you're interested in it, you can kind of expand into other areas and do different things. But it's just like a great starting point, I think. And like personally, like I say, go back to, you know, what our expectations are. You know, interest rates are going to go up, and it's not inflation, but I think overall the world is going to be better off in 30 years time than it is now. So there's nothing wrong with putting some money in an index ETF global tracker. I think they're great, to be honest. Like, they're fantastic.
Excellent. Now, interesting question from Grant. Again, well done, Grant. You bring us some really good questions here. What are the chances of crypto being allowed within ISAs and SIPs at some point? I'm going to put this to Sam. My feeling is pretty slim, given the approach of the FCA towards anything crypto. They just go crypto. What do you think, Sam?
I'd say slim. Slim. But one thing I would say about crypto, I think a lot of markets are lower right now. And I think with crypto as a whole, what's going to take that next leg for it to go to the upside is going to be further adoption, further regulation. So if we were to fast forward a few years and that question's asked, it might not be, well, there's going to be very slim chance. So right now, slim, don't see it happening anytime soon. But if we get the regulation, we get the institutional adoption that we're starting to see down the line, then maybe the answer to that changes. But short term, I don't really see it.
And I would just, if I may just jump in there.
Yeah.
So yesterday you saw Fidelity, which is the largest pension manager in the United States, announced that it would allow people to put Bitcoin in their US savings, in their US pension savings accounts, their 401ks. So it'll come. It's just a question of when.
Oh, excellent. Oh, we've got Justin here. It's probably my fault. I probably told Justin that we were starting later. Justin, are you here? Justin Urquhart-Stewart.
Hello.
Hello there. Lovely to see you, Justin. I probably told you the wrong time, didn't I? We've been here since 6 o'clock, but it's been lovely to have you now. I'm going to come straight to you, Justin. Is that all right? Justin Urquhart-Stewart, founder of 7 Investments. I've known him since Barclays Stockbrokers days, and now running Regional, aren't you, Justin?
Regional, yeah.
Yes, which is a fantastic one. Lovely to have you, Justin. Thank you. Now, I'm just going to go straight in with you, actually, because I've got 2 questions here. One from Kenneth saying, what about whiskey and wine? And he's talking investments here, just before we get excited there. And also Andrew is saying everyone should stock some long-term foodstuffs. With extreme fertilizer prices and shortages, food will double within 12 months. So I guess we're talking commodities and anything related to food. What do you think about whiskey, wine, and food-related investments at the moment?
Well, let's separate those two, as those questions did. Whiskey and wine. Remember, whiskey and wine market is completely unregulated. And in terms of control market, the validation of you're dealing with, does the stuff actually exist? Because quite often you're asked to buy wine in bond go and have a look at it. You probably can't. It's not very easy anyway. And also, it's quite a small market. If I said it was illiquid, that's not a bad pun on the fact it's wine. So it's also illiquid on the basis that you may have something to sell, but no one else wants to buy it. So be very careful of all of that. There are also sharks out there. People have been trying to push even wine funds. And there was a certain fund manager a few years back, that was going back about 10 years, and it used to actually, it's barely around now, called CRU, and it used to try and market itself as somehow connected to the wine industry, but you really didn't know how, and I'm afraid it didn't work either. So be wary of those sort of things. And also, if you are buying wine, and I do actually buy wine, mostly to drink, but some as investment, and I only buy the best quality ones I can get, and on the basis that actually that's a pretty good market and I can validate what it is. Otherwise, barge pole comes to mind.
Excellent. I've got a question here from Nigel Ryan. Now, it's a shame that Gordon isn't here, because I know Gordon would agree with this. Nigel says, do any of the speakers anticipate the collapse of the current debt-based banking system? I'm going to go back to you, Justin, first for that. Do you think that we're going to see the collapse of the current debt-based banking system?
You're going to see a huge change now in the way that actually we're trying to operate all kinds of debt, and that will impact on the banks and their capital. The banks are very pretty well capitalized at the moment, so there's no reason actually why any of them should be collapsing. Although there are sort of various bubbles around the place, actually they have been very conservative over the past few years. Remember, the key area that we're actually losing heaps of money on was the management side, all the corporate advisory side. And when you start mixing up the old traditional merchant banking side with the corporate, more commercial high street banking side, they don't mix together. We learned that from the 20s. We had to have Sarbanes-Oxley there, which separated the two out. And it was only when a certain president decided to actually say, we don't need that anymore, we'll let them merge again. And they did exactly the same as before. They're creatures that don't change their stripes, I'm afraid. So are we actually going to see a collapse of the banking system? No, you've got to see a radical change in the banking system. That's apart from the fact you can't see them on the high street anymore because they barely exist. But also the way we're going about funding ourselves and new types of investment structure coming through. And I don't just mean the likes of the crypto stuff with blockchain. There are all sorts of other variations going through, which technology allows us to do. But just one other thing, I did mention the other side of that question you had to start with about commodities.
Oh, yes.
Have a serious inflationary issue here. If you look at input inflation into manufacturing at the moment, it's running about 13%. 13%. That does not mean that we end up paying 13%. You could probably halve that. But nonetheless, we're seeing inflation worryingly almost becoming embedded.
Yeah.
Now, the good thing about inflation, of course, it's month by month. So the bad month last year when oil was going up very dramatically will actually drop out. But you're seeing inflation becoming more embedded into salaries, into also the cost of production. And remember, it's been all the papers, Ukraine is one of the largest exporter of wheat and sunflower oil and such like, along with Russia, Canada and America. And they had a rotten harvest last year. Global warming, take your pick. But that's not the issue either. We're going to be spending a huge amount more on inflation that doesn't exist yet. This will be in the autumn going through to the spring. But there's another issue, and that is those countries which are completely dependent upon Ukrainian exports of grain and such like. And it's those which have quite often got weak political structures and therefore open to social disruption. Tunisia, Libya, Egypt, let alone the basket cases of, say, Lebanon and Eritrea and Yemen. And if you start seeing further destabilization like that, that's when you start seeing the likes of ISIS coming in and causing more problems. Does that affect us? Yes, it does, because it affects the one word that runs any economy, whether it's us in our little domestic world or internationally, confidence. And the confidence so far has been there, but you can see how this could get very easily rattled. So I'm very concerned over the forthcoming year. Do we end up with a recession or not? Remember, a recession is only 2 quarters of a shrinking economy, so it's not that huge. But nonetheless, it could turn very nasty indeed. And with such a ghastly issue happening in Eastern Europe at the moment, this is something that no one would have actually really foreseen breaking out into such a conflagration, and could potentially get significantly worse, as the more scaremongering journalists around us will happily say.
Absolutely. Well, actually, Andrew's point here, I think, because I mentioned about commodities, but Andrew's saying, as a few other people are saying, and I'm saying as well, it's probably a good idea for us to be storing up some tinned food and all of that, because this does seem to be going to hit the whole world. But as you say, in particular, Africa, Middle East, when people can't eat, then we have big problems. Ben, you're more phlegmatic about things than Justin is. Do you agree with Justin, or because you were saying that you don't think that inflation is going to be so bad over the next year?
I mean, as I said at the beginning, this is still a new world, right? This is a world that's going to have less growth, it's going to have less market returns, it's going to have higher inflation, it's going to have more market volatility. So, let's sort of take that as a given. But no, I don't think we're in a sort of hyperinflation environment where inflation is just going to keep rising. I think central banks, part of the problem we have right now, and part of the reason that we're talking about recession, is because central banks are responding to this problem. Central banks are starting to raise interest rates, and they're doing that so they can slow the economy down. They want a slower economy. Now, obviously, the trick is to do that without tipping us all into recession, and we'll see whether that's going to happen, or not. But let's not lose sight of what they're trying to slow the economy so they can bring inflation down, and so we don't have hyperinflation. And really, what we're talking about, on this call is how do we protect ourselves from that?
Yeah.
I think inflation is going to come down, but it's still going to be higher than we've had in a generation. And we need to, and to Justin's point, the risk is certainly that it's higher rather than lower. And therefore, you need to be looking at these hard assets that protect you from that. You need to be looking at commodities, and we all have different views, but we could always be wrong. And I think we need to sort of recognize that. And sort of run that sort of balanced portfolio that sort of protects us if we are wrong.
Jasmine, there's a point here on central banks, because they've got, and you're absolutely right, central banks are trying to control it. It was interesting to see last week how the ECB didn't move rates. And it's a terrible dilemma of central banks. Do I raise rates? Because currently they're still at the emergency level almost that they were post-banking crisis. They want to raise rates, quite rightly, to try and control inflation. But on the other hand, raise rates too much and you stop the growth. So it's the devil's soup to try and actually work out which way to go. So quite understand that I have the sympathy of this, of how they make the decision. But I think rates should be going up, if you're being really cynical about it, because I've got the ability to cut them again when things slow down. But when they're at naught, it's quite difficult to cut them.
Yeah, well, exactly. And I do. I mean, Gordon Kerr is not here anymore at the moment. So, but he was mentioning, the problems he sees in the Eurozone particularly, and because you've got various economies. I mean, Spain, I think it has inflation to about 9.5%. Germany's is about 8% or something. It's really high. So Sorry,
Jasmine, just expand that a little further, because Malta is at 4.5%, Lithuania is at 15%. So how do you run a single currency when you've got that variation going on? The euro will fail eventually, not tomorrow, because the politicians make sure it won't fail. But unless you have a harmonized fiscal taxation system, which you're not going to get above the Sundays, you're free move to capital most of the time, and harmonized regulation, that's probably getting closer to it. But fundamentally, you've got this fault line running through it, and you will never be able to resolve that. In Britain, even though we have to put up with the Cranky's love child, what's her name? Mrs. Sturgeon, and she can have a certain element of tax raising powers, the fiscal system is very much the same. So we can run a single currency like that because we have those disciplines in place. And so therefore, that's why the euro will eventually fail. And it fails when the politicians give up on it.
Interesting. Well, hey, Justin Urquhart-Stewart has spoken. I think this is a really a great way to finish. But finally, I would like to finish. Well, before I do quite, there's a rather nice quote here from Grant regarding food shortages. There are only 9 meals between mankind and anarchy. That's Alfred Henry Lewis in 1906. Very good one. I'm going to remember that. Thank you. But just to finish off, I'd love to know from you guys, finally, what your biggest tip is for investors right now to operate defensively, but make money. Ben, could I start with you?
As I said at the beginning, the biggest risk has been out of markets, not in market. And if you're worried about volatility, and it's completely natural to be worried about it now, just dribble that money in. As I said at the beginning, making money in markets the next week, day, month is a coin toss, but I guarantee you'll make money over the long term.
Nice. Sam, what do you think?
Yeah, short-term pain, long-term gain. Invest regularly, diversify, and think long-term.
Great. George, let's see if we can hear from you. What are your tips?
Yeah, so I think like people's long-term plans, this kind of stuff should have been factored in a little bit into it. If it wasn't, and you find yourself too overexposed in growth and crypto and risky stuff, have a look at kind of like more like dividend stocks, investment trusts that pay an income, anything like that, just to kind of like stable things down and while still getting a bit of a return. It just to kind of balance things out. But your long-term plan shouldn't really like change that much unless you were overexposed in the wrong areas to begin with.
Great, thank you. And finally, Justin, what do you think? I'm just thinking, before I speak to you, I'm just remembering a friend of mine who said to me when I said, where should you put your money? What should you buy in times of great volatility? And he said tinned food and weaponry. What are your views?
Well, weaponry is certainly going to be a lot of demand, and certainly also tinned food as well. I have to say, some of the quality of the corned beef is somewhat worrying. No, your Daniel was saying quite rightly, invest in that. It's that another corny sort of city phrase. It's not timing the market, it's time in the market. It's one of those nauseating things, but it's actually true. The only time I've really lost money in the market is not being in it.
Yeah.
The greatest strength we have as an investment people is compounding. We have businesses that pay dividends. Some that can't pay dividends or cut them, which is always painful. But actually, in this country, we depend upon dividends being paid for a lot of those pension funds. So the likes of Shell, banks, and things like that, regular payers that were less than before, that compounding is your secret return. It maybe sound dull, but in my life, dull's quite good. This year's fashion fad is next year's tank top, and I've got too many of those to answer to.
Excellent. Thank you so much. Thank you, all of you. Justin Urquhart, Stuart, been lovely to have you. Gordon Kerr, who was with us, Benjamin Laidler from eToro, Sam North from eToro, and MoneyMagpie's very own from Costa Rica, George Sweeney. Thank you so much for all of your help. Now, this, as I mentioned at the beginning, nothing that has been said today should be taken as financial advice. It is information, and it's good information, frankly. We are recording this. It will be uploaded onto moneymagpie.com. So do have a look. We will be sending it out in the newsletter. Thank you to everybody who's come along. It's been really great to have you, and hope to see you at the next webinar. Thank you.